Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So the company we're analyzing today is Sirca Paints India Limited. It basically manufactures and markets premium wood, glass, and metal coatings along with decorative paints and finishing products under the Sirca brand. It also sells certain add-on products like paint thinners, etc. under a separate Welcom brand. They are the exclusive licensee of the established Sirca brand for India, Nepal, Bangladesh, and Sri Lanka. So they own exclusive distribution and production rights for these four, basically for the Indian subcontinent. And the company is amongst the top 3 premium wood coating brands in India, and it is a major market leader in North India. It operates via both B2B and B2C channels. So B2C contributes around 70%, which is mainly through their retail dealers. They have a strong distribution network. And apart from that, they also have B2B tie-ups with OEM clients like Godrej. So basically, they've tied up with many door manufacturers, etc., wherever there is wood coating required. Moving ahead, their revenue is largely recurring and it is driven by repeat orders from dealers and OEMs, and it is not project-based. And their core products include Italian PU wood coatings, acrylic finishes, UV curve products, melamine polishes, wall paints, and metal or glass coating. These are the entire product range which they offer. They basically started in 2006 and they at that time were only a maker of Italian PU coatings. But since 2019, they've scaled up with their own manufacturing and technical collaboration with Sirca Italy. So this is basically their brand portfolio of products. So they've categorized it as economic, entry level, and luxury. So in India, they are only positioning their products. They are only selling their luxury segment products. But in other countries like Nepal, Bangladesh, Sri Lanka, they are also selling economic range and the entry level range. So those are slightly more quality, but they also cater to that market. And these are the different brands under which they sell their products. So they have 4 brands: Sirca, Unico, Oikos, and Welcom. So these all cater to different market segments, basically. And recently, they've also acquired Wembley, which is a very well-established brand in the similar industry. So they sell decorative items and paint-related products through this Wembley brand. Moving ahead, so basically their FY25 revenue mix, most of their revenue came from wood coating, which was under the Sirca brand. So 85% came from the wood coating, and the products under Oikos brand contributed 7%. The remaining 8% came from paint thinners under the Welcom brand. In terms of their geographical revenue concentration, they are quite concentrated in North India. So 70% of their revenue comes from north part of India, of which 40 to 45% comes only from Delhi. So their geographical concentration, it is quite. And talking about their production capacity, they have 30,000 tons for PU, nitrocellulose, melamine, thinner, wall paint production. Overall, their capacity is 30,000 tons. And the acquisition of Wembley brand recently at March 2025, the 3 new manufacturing facilities which they intend to integrate over a period of time. And as of November 2024, their capacity utilization stood at 60% overall. And they mentioned that they would like to increase it to 75% by the end of FY25. They have a very strong client base of over 900 OEMs. So I've listed some of the clients over here. Yes, so moving ahead, talking about their management overview, they have an experienced and stable leadership team, and they all have very strong academic backgrounds and industry roots. So the company is mainly led by the chairman, Sanjay Agarwal. He has run the company for nearly 2 decades, and his son joined MD. So there is clear succession planning in place. So Apurva Agarwal is ready to take over after his father. And there's a proven track record in scaling operations, entering new markets, and maintaining financial and operational discipline in the past. And apart from that, there has been no major regulatory or legal issues in which the company is involved. So yeah, they are credible and they are capable of leading the future. Coming to the industry analysis, the Indian paints and coating market was valued at 14.53 billion in 2020 and it is projected to reach 26.78 billion by 2030. So it is set to grow at a CAGR of 9.13% over this period. Mainly, this industry is dominated by market leaders like Asian Paints, Berger. These are very strong, established, and old brands. And Sirca Paints, I would say, is relatively a small niche player, and they mainly target the premium category of Italian, and they have an Italian brand positioning. So they are basically more focused on premium quality products, although they do cater to the mass segment as well through their other brand, but their main positioning is a luxury Italian brand. And they face limited direct competition in the high-end wood ranges, but their activity mainly overlaps in the mid-tier players in the PU and melamine space. Apart from that, some of the key trends in this industry involve margin volatility, rising demand for eco-friendly coatings, which the company is involved in, shift towards affordable products, and tier 2 and tier 3 market expansion, which they are undertaking through the recent acquisition of Wembley. Talking about their historical performance, so their revenue CAGR has been high, around 27% over the last few years. And their profitability has mainly been affected in the past due to COVID related operational reasons and input cost increases. So they're basically the oil prices directly affected there. And apart from that, there have also been more recently, there have been increased market competition and facility integration related issues due to which their profitability saw some issues in recent times. Apart from that, their receivables to revenue has also been reducing since their time. So I'll be covering that ahead. Talking about the future outlook and management commentary. So they want to target higher value products, and basically these products which were earlier being manufactured in Italy, now they have started being produced in India itself. So that gives them a very strong cost advantage. Management is guiding for a minimum revenue CAGR of 40% in the next 3 years. So this is what they claim. And EBITDA margin is to remain at the current levels of 18 to 20% in the long term, again, as per their con call. And they are leveraging the very well established Wembley brand. And in the future, as I mentioned, they want to integrate the newly acquired 3 manufacturing facilities for better operational efficiencies. Apart from that, in FY25, what they did was basically they had to sacrifice some short-term margins in order to maintain their market share because there was increased competition in the market. And they said that this trend might continue into the future if necessary. And apart from that, they say that their core focus will always remain on the premium wood coating segment, but they also have a complementary decorative and mass market range, so that will help them accelerate their all India expansion. Now, coming to the bull case, they are the exclusive licensee of the globally established Sirca brand for India, Nepal, Bangladesh, and Sri Lanka. They started manufacturing their products in India, so that gives them a very good cost advantage, and they've cut their imports by around 55%. So that is again a helpful point. And their inventory levels are reducing continuously, so they have lower working capital requirements as well. The recent acquisition of the well-established Wembley brand will also help them expand their market reach and target the complete value segment in the paints and coatings area, and it will also cater to the industrial demand. Apart from that, they have a strong established network of 4,000 distributors and over 900 OEM clients, and this will only keep increasing with the recent Wembley acquisition. They have a tie-up with Oikos, so Sirca is to benefit from the rising demand of eco-friendly and premium decorative paints in India. And they've also secured new OEM partnerships in modular furniture and door manufacturing. So this is basically strengthening their B2B ecosystem. And lastly, they cater both to the premium as well as mass market demand through their different brands. So basically, there is something for everyone that they have to offer. Now, coming to the bear case, their raw material input cost is directly affected by increase in oil prices. So this will constantly keep their margins under pressure and varying. Their license has been issued. So the brand license has basically been issued for a period of 15 years starting 2018. And the terms clearly mention that the renewal of the license will depend on the performance and on mutual agreement. And in case there are any issues in renewing the license, then this can ruin their entire brand image and their positioning as a leading Italian premium wood coating brand. there is high geographic concentration in North India and Delhi region. So there is any logistical disruption or any regulatory action can have a heavy impact on them. Also, there were some environmental concerns in NCR, which have led to many construction bans in the past, which has directly impacted the company's revenue. So basically, this happened in Jan 2025 to them as well. So due to this construction ban, they were unable to recover from the incurred in the quarter. And basically, they were not able to recover from the revenue losses in the quarter. They also face intense competition in terms of reach and brand recall from, as I mentioned, very well established, strong market players like Asian Paints, Berger, Nerolac, etc. And lastly, most consumers, when they intend to get their homes renovated or anything like that, the issue is that they see it as a long-term investment. So they are very less likely to experiment with a brand which they haven't tried before. So this makes it a very strong mode for established players like Asian Paints, etc. And harder for small players to compete with the established ones. So they had their IPO of 72 crores in 2018, out of which the capex was 33 crore, working capital was 25 crore, and general corporate purpose was 14 crore. So I've given a 3 because it was for a mix of capex and working capital. Also, they had a preferential allotment in FY24, and this was mainly for capex and acquisition of the Welcom brand along with introduction of new product lines. Coming to the director track record, their CEO, the chairman and MD is Mr. Sanjay Agarwal. He has 32.4% shareholding, and his son is Apurva Agarwal, who is the joint MD. He has 2% in the company. And Vijit Singh Ben, he was the original co-founder of the company, and he's the non-executive director, and he currently holds 14% of the company. And I've given a 5 because they weren't involved in any regulatory or legal issues themselves. Apart from that, there is only one unlisted subsidiary of the company, but as per SEBI regulations, it was not material. So there were no major related party transactions. The only thing was the CEO salary, etc., that was mentioned in the related party transactions. So I've given a 5. Moving ahead, the board consisted of 50% independent directors and there was no promoter family dominance. So I've given a 5 for that as well. Now coming to CEO salary, again, it was within limits and nothing very high. So I've given a 5 again. There were no major CEO or CFO resignations and there were no auditor changes as well. So I've given 5 there as well. And coming to auditor opinion, also everything was clear and they don't have any debt. So there was no credit rating done. So I've given a 5 there as well. And they weren't involved in any regulatory or legal issues and their investor disclosures are all clear. So I've given 5 there as well. Moving ahead, in terms of business concentration risk, they haven't specifically disclosed it, but the prospectus did mention that they don't have any major customer concentration. That, along with the large retail customer base which they have mentioned. So for that reason, I've given a 3. And moving ahead, in their cash flow to EBITDA, so basically what happened is in FY20, their inventory doubled, which made their cash flow from operations to crash. And similarly, there was another inventory build up in FY20. So these two were the major reasons for the fall. And there has been a sharp EBITDA growth with slight dip from the FY22 levels. So this was the lower ratio in FY24. But overall, the ratios have been relatively high and stable except for these few dips. So I've given a 3 for that. Moving ahead, the company has seen a solid revenue CAGR of 27% over 4 years. And receivables also have consistently been in control. In fact, they've improved since March 2020 levels. And there were some unfavorable payment terms in FY 2021 because of COVID. So due to this, their receivables slightly increased. And in FY 18 and FY 19, there was some basic GST related and issues, and they were also expanding into new products and new geographies. So due to that, there was some increase in receivables, but otherwise from those levels, definitely the company has cut their receivables down. So I've given a 5 for that. Moving ahead to their inventory trends, inventories basically almost doubled in FY20 because what happened is that the Italian company's plant kept running even during the lockdown when this company's plant was not operational. So due to this, they were stocking up to 8 to 9 months of inventory. So this basically caused a major inventory buildup to avoid any further supply side disruptions. And after that, this trend continued. But recently what has happened is that now FY24 onwards, they've reduced their import dependency by 55%. So now the inventory position is set to improve after this in the future. Moving ahead to their cash conversion cycle, the company is making an effort to control its receivables, which is quite evident through its falling receivable to revenue ratio. And inventory days have also been falling with reducing dependency on inventory, as I mentioned, on their import from Italy. And this is basically causing the fall in their cash conversion cycles from these peak levels over here. But overall, still the inventory levels I feel are quite high. So I've given a 0 because their cash conversion cycle is very stretched. It is at around 194 days. Coming to capex versus revenue, the acquisition of the Wembley brand added 3 new units in 2025, which mainly caused this fixed asset turnover dip. And apart from that, they've also been regularly investing in their fixed assets in their plants to expand their product range, etc. Also, that is what the capex has been incurred for over the years. But relatively, it has been more or less stable. And they've seen a high fixed asset turnover as well until FY25. So I've given a 5 for that. And they don't have any debt in the company, and interest coverage is very high, so 5. And coming to their liquidity position, their higher inventory levels is what is causing the inflated current ratio in FY24. And the industry average is ratio is 0.9 to 1.5 for the quick ratio, and industry average current ratio is 1.4 to 2.1. So considering the industry average, this company has definitely done better. So I've given a 5 for that. To their ROCE and ROE, they saw falling profits in FY20 and 21, which were mainly COVID related. So due to this, their ROE and ROCE was heavily impacted. And similarly, the same thing happened in FY25 as well. So due to their reduced profitability, they saw a falling ROE and ROCE. But in FY23 and FY24, margin improvements basically led to higher ratios. And despite the recent fundraise, their ratios have remained strong overall. So this does display that they have strong profitability. Lastly, coming to their growth consistency, their revenues have been growing well since the last 4 years. And in FY21, basically their margins fell due to operational issues related to COVID. So their plant was shut down for, I think, half a month approximately. And other than that, they also faced a lot of forex losses on their high imports. And there were also elevated input costs, which the company had to incur. So due to that, basically, they saw some FY21 and FY22, they saw some margin dips. And in FY25, what happened is that their gross margin grew. However, their PAT still fell. So this was basically because they were facing higher competition in the market, due to which they had to offer more discounts to their customers because they wanted to increase revenue, maintain market share, and maintain their volume, grow their revenue volume. So due to this, despite an increase in their gross margins, their PAT still fell. Apart from that, we also saw higher distribution expenses post acquisition of the Wembley brand. So again, this was a kind of operational issue which they couldn't do much about. But overall, even during the difficult times, even at the lowest, their PAT margin has consistently been around 12 to 13%. For that reason, I've given a 5. So overall, the company's score is coming to 82.
So this is Sirca Paints is one of the companies which has moved from SME board to main board. So kudos to the team and the management for executing consistently last 7-8 years. So a typical example of like long-term investing at play when the company and the management executes. So currently the stock price is at 45, 46. Management is guiding for 40 CAGR. They have done that in this quarter. So let's see if they continue to execute. 40% is a bit uphill task, but if they do, then I think they have a long runway to go, and not 40% for a year, but then like for 3 years, you're guiding 40% plus growth. So the worst case and the best case doesn't factor in 40% growth, it's just factoring in 10% growth. And let us just take the best case going with the management. And the current PE was 45, 1 year forward PE of 40, the price target comes to 521, and the current price is 442. And if they actually deliver 40% growth without compromising on the margin, then even on a 1 year forward PE basis, it looks interesting. Even if it goes to 30, yeah, it's around 30, but then this top line would be 500 plus. You have a margin of CRI. If you have a longer term perspective, they are doing, they're free cash flow negative because they have done a huge capex of 100 crores.
It's up and running now. They have done a PAT of 53. Last year, their operating cash flow is 54. Just let's take 53 as the earnings to go with. A required rate of return of 20, terminal growth rate of 3, and a holding period of 5. On a conservative basis, the 5-year P multiple of 25. Then the implied earnings growth rate should be 30. Management is guiding for 40. So hopefully everything falls in place. Then 20% CAGR is something looks extremely possible. So due diligence, but based on the reverse DCF calculation and management guidance, current price has a lot of margin of safety. It's also reflected in the stock price. Cross its 450 resistance level, 450, 440 level with some positive market condition. It should hopefully be reflected in the price as well. Any final take?
Yeah, the only thing I'd like to mention is that, like, considering the only negative part about the financials of the company, which I found was the high inventory buildup in the past and the cash conversion cycle. So I believe if these two things come down, then I think this company has a very strong growth prospect in the future.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.